Today, we're shifting gears a bit to discuss single-family real estate properties and how they're valued when compared to commercial real estate properties. Understanding this will help you see why investors often start with single-family homes, but eventually move toward commercial properties. We'll also look at two key financial tools, velocity banking and the IRS 1031 exchange, both of which can accelerate this transition. So let's begin. Single-family homes are primarily valued by looking at comparables, or comps, meaning recently sold homes in the same area with similar features. The idea is that buyers will pay what others recently paid for comparable properties nearby. Factors influencing single-family home values include location, which includes school districts, proximity to amenities, and safety. Market trends, such as housing supply and demand. Comparable sales, which are the recent sale prices of similar homes nearby. And also, condition and upgrades, like updated kitchens, new flooring, etc. This market-driven approach means single-family property values are heavily influenced by current local real estate trends and what comparable homes are selling for, often making their value more volatile based on these external market conditions. Now, how about commercial properties? Commercial real estate property values, by contrast, are income-driven. The primary metric here is the net operating income, or NOI, generated by the property, with the formula for valuation often tied to the capitalization rate, also referred to as cap rate. This income-based approach means commercial real estate investors have more control over the property's value by increasing rents, improving management, or optimizing operating costs. The value reflects the property's income potential rather than market comparables. In a single-family home, building equity relies on market appreciation, loan amortization, and sometimes forced appreciation through renovations or improvements. It's a slower process than in commercial real estate because the value isn't directly tied to income. Instead, it's tied to external market conditions, which can fluctuate based on demand, interest rates, and local economic factors. While investing in single-family homes can lead to good returns over time, it's harder to control value growth. However, there are strategic tools, like velocity banking and the 1031 exchange, that can help increase equity quickly, potentially positioning investors for larger commercial property investments. To pivot from single-family properties to commercial investments, it's essential to understand how these financial tools can help speed up equity building and defer taxes. Velocity banking is a strategy designed to pay down mortgage debt faster, thereby increasing equity. This approach leverages a line of credit, typically a home equity line of credit or HELOC, to pay off the mortgage principal directly. Here's how it works in practice. First, you leverage a HELOC. You use the HELOC to make lump sum payments toward the mortgage principal, significantly reducing the loan amount and interest costs. You deposit all income into the account, which keeps the average daily balance lower, thereby minimizing interest charges. All bills and expenses would be paid using this same line of credit. By continuously attacking the mortgage principal in this way, you can reduce a 30-year loan down to as few as 5 to 10 years, increasing equity faster than standard payments alone. This accelerated equity growth positions you to leverage the property for cash-out refinances, enabling you to free up capital for other investments. Now, don't worry if you can't see the full benefits of this strategy just yet. This is only a high-level overview. We'll get into more detailed specifics later on in the course. Next, we have the IRS 1031 exchange. The 1031 exchange is a powerful tool that allows real estate investors to defer capital gains taxes when they sell one property and purchase another like-kind property. The IRS allows you to sell a property and roll over the capital gains into another qualifying property without paying immediate taxes on those gains. By deferring taxes, investors can reinvest 100% of the sale proceeds, compounding wealth more effectively than if they had to pay taxes up front. For single-family investors, a 1031 exchange can be used to trade up to a commercial property. Over time, this enables an investor to transition from single-family homes to larger, income-producing commercial assets, which can generate greater returns. So let's put it all together. By using velocity banking, you put yourself in a strong position to leverage the property, either by refinancing or selling. Then, using a 1031 exchange, you can roll those proceeds into a larger commercial property without triggering capital gains taxes. Here's an example. Let's say you own a single-family home. You begin to apply velocity banking to rapidly pay down the mortgage on your property, building equity faster. Once you've achieved substantial equity and identified a favorable market phase, you sell the property, capturing more of your gains. When sold, you then use the 1031 exchange to defer taxes, allowing you to reinvest the full amount into a commercial property with higher income potential. This approach combines both strategies to maximize your capital and accelerate the transition from single-family to commercial real estate. By starting with single-family homes, you learn the basics of real estate investment and begin building equity. But by applying tools like velocity banking and the 1031 exchange, you can leverage that equity to scale into commercial real estate. These techniques can help you achieve greater returns, build wealth faster, and set the stage for a more financially secure future. Any questions on how these tools might fit into your investment journey? Drop it in the comments below. I'll see you in our next lesson.